With the new tax year fast approaching, I thought it would be well worth giving you a quick roundup of all the things I think you need to do before April the 6th. And I think this year, more than ever, some of these things could be crucial to your success as an investor and generally as a taxpayer. And it could save you hundreds, if not thousands of pounds now and into the future. So here's 5 things you need to do, and let's start right from the top. Up first, we need to talk allowances. Now, over the last couple of years, we've seen some major changes to 2 of your personal allowances, which are your dividends allowance and your capital gains allowance. Now, as a quick refresher, everyone in the UK gets a certain amount they are allowed to receive completely tax-free in the form of both dividends and capital gains. And this is on top of the allowances you already get for the rest of your income. Last tax year, the allowances were £2,000 for dividends and £12,300 for a capital gain in any given tax year. But this year, they are just £1,000 for dividends and £6,000 for capital gains. But next tax year, these are being reduced even further to £500 for dividends and just £3,000 for capital gains. Now, just as a quick example, a dividend could be something you earn from holding shares which pay you a dividend, or this could be a dividend from your own business. And I'm sure quite a few of you out there do pay yourself using dividends. So in the current tax year, let's say you earned £5,000 in dividends and you're a basic rate taxpayer, meaning that you earned up to £50,270. You would pay no tax on the first £1,000 and then 8.75% tax on the £4,000 that was left, which would effectively be £350 that needs to be owed. Then a quick example of a capital gain might be you selling some shares in a general investing account that you bought for £5,000 but sell for £10,000. Or it could be something like a vintage car or even a second home. Anything that you sell and make a profit on, and there are kind of little exceptions to the rule, make sure you look those up. Now, the rates that you pay on capital gains do vary, and there's also even a higher rate for selling residential property that is not your main home. The rates, as you can see, will vary from 10% up to 28% depending on the rest of your income and what you're selling. Now, putting that to one side, the reason I brought this up is that these allowances are use it or lose it. If you don't use up your dividends allowance or your capital gains allowance this tax year, you cannot use them next tax year. And as you just saw, these allowances are being cut in half next tax year. So what you need to do is be smart about it and make sure that you can use them if you can. For example, here's one where I think might apply to a lot of people. Say you do have an investing account that is just a general one and outside of an ISA. Now could be the time to sell some shares to avoid paying taxes on them later. I know a couple of years ago I had a big part of my own investments in a general investing account, and I didn't think much of it because the allowances were pretty generous. But now you do need to think again. So what you could do is sell any shares that you might be in a profit on. If that profit is under £6,000, you'll pay no tax at all. Likewise, think about what you're invested in. If you have some big dividend stocks, or maybe you're due a big dividend soon from them, see if they're due to be paid before the new tax year starts, or maybe even think about selling them if they were to go over your £1,000 allowance this year. I know it's not a huge amount of money, but at the end of the day, all of these little savings add up and compound over the years, especially if you're a long-term investor. So go through all of your accounts, work out if you could be liable to any taxes, and figure a plan out that works for you. Oh, and also you could be very smart and do a little trick, which I'll touch on later, but first let's head to the next step. Here's where I wrote down, give yourself a quick refresher and all of the limits on ISAs for you, your partner, and your kids if you have them. Remember that just like the allowances from point 1, your ISA allowances are also use them or lose them. If you do not use them this tax year, then you'll miss out and that allowance is gone forever. So quick recap, I'm not going to bore you with all the super basics, let's just look at this on a high level. Each adult in the UK has a £20,000 allowance that they can use across all of the different ISA accounts, which are your cash ISA, your stocks and shares ISA, your lifetime ISA, and an innovative finance ISA. The limit is just how much new cash that you can put in, and there's no limit to what an ISA can grow to. And you can mix and match all you like into each account, but do just be warned that the lifetime ISA is limited to £4,000 per tax year that you can put in. Now, here's a couple of tips worth thinking about. Firstly, if you're in a family of 4, let's say you and your partner and 2 kids, consider your allowances together as a unit. So firstly, if you have a maxed out ISA, the next step might be to also use your partner's ISA and see if you can max that out. So in total, you have up to £40,000 to use. The next step then might be to do the same with the kids, who also get a junior ISA limit. Per child, there is a limit of £9,000 in a tax year. There's junior cash ISAs and even junior stocks and shares ISAs, so you can choose whatever level risk you want to take. Now add those allowances together with yours and you now have £58,000 worth of tax-free investing or saving in a family of 4. But wait, there's still more. You can even start a junior SIPP. So that's basically a pension for every child too, and you're allowed to put in up to £2,880 per child in a tax year, which gets boosted up to £3,600 by the government. So again, add up that in total and you get another £7,200 to add on to the £58,000 you have already. So more than £65,000 worth of tax-free investing and saving in a family of 4. Obviously, this is the extreme example and for a few very wealthy households. But even if you are on much less money, the allowances still apply and you can mix and match whatever you have to suit your needs. On that note, if you are looking to get your own stocks and shares ISA this year, I do put the platforms I use in the description below and you can get yourself some free cash or free shares for signing up. And thank you to the many hundreds of you who've taken advantage of that so far. Okay, next up, this point leads nicely on and it's linked to what we've just discussed in point 1 and 2. Consider doing something called bed and ISA. It might sound like a new fad diet or some weird exercise routine, but it's pretty simple and the idea is that you will sell any investments that you might have outside of your ISA and then take that cash and move it inside an ISA. And the reason you do this is so that in the long term, that investment can grow without any dividend tax or capital gains tax. And you can pretty much buy the exact same investment or the shares inside the ISA as you used to own outside of it. Now, there is a caveat with this one. It's not some magic way to save on taxes now. It's all about making savings in the future. If you wanted to bed an ISA, an investment of £10,000 that you only paid £3,000 for, then you do end up with a profit or a capital gain of £7,000. Now, there's no way of getting away from the fact that if you sell those shares, you have made a capital gain that you will have to pay tax on, regardless of how quickly you put that cash into an ISA and bought the same company. But if you think carefully about it, you could also be clever and see if there are some shares you can sell at a loss to cancel out that gain at the same time. Then once that's done, you might be able to get all of that cash inside an ISA so long as you don't exceed the £20,000 allowance. For example, one of your shares might be in a profit of £7,000, but another investment could be at a loss of £5,000. If you sell both of them, then your actual capital gain is just £2,000. And if this is all you had this tax year as a gain, then there would be no tax to pay as this is under the £6,000 allowance. Nice and easy, I hope this helps someone, but just remember I'm not your financial advisor, nor am I an accountant either, so please do make sure you verify everything here on the government website as things can change very quickly. Okay, next up, this one is so important for everyone. Check that you're getting paid efficiently. This might sound weird, but what I mean by this is that you could be better off paying more into your pension before tax, rather than just getting a bigger pay package and having all kinds of other issues. For example, this came up recently as a comment on another video, but for those of you who receive child tax credit, you'll have to pay this back once you earn over £50,000 and it gets removed completely if you earn £60,000 or more. So as an example, rather than get a pay rise at work from £50,000 to £55,000, you may choose to ask your employer to pay into your pension instead before tax. In this way, you can keep your child tax credit. Obviously, with a pension contribution, it's not money that you can access anytime soon, and you will have to think about some tax on the way out. But this could be a really good way to save tax today and prepare for retirement at the same time. Likewise, this is a similar situation if you find yourself as a high earner and in the higher rate tax bracket. Once you earn over £100,000 a year, your tax-free allowance gets dropped by £1 for every £2 that you earn above £100,000. And this means that if you are lucky enough to earn £125,140, you will end up with tax to pay and no tax-free allowance at all. And you actually fall into a horrible 60% tax rate effectively between those two amounts of earnings. No need to get the tiny violins out just yet though. If you do find yourself in this situation, there are several ways to reduce your take-home pay to keep it under 100k if needed. Firstly, just like we spoke about before, you can make contributions into your pension to reduce your take-home tax burden. It's always worth speaking to your employer about this to see what they can do, but then you can also do this as well from your side and claim that tax back afterwards. Secondly, you could ask if your employer is able to give you a non-cash based raise rather than a cash one. Yes, there will be loads of details here that you need to pay attention to, but this could be something like a nicer company car, private health insurance, or other benefits like that. Finally, there are investment schemes where you can get tax relief for investing in small companies and startups. Now, all of these things can help, and as usual, work with your accountant or professional to get it sorted. And just as a final reminder, if you are a high income taxpayer, do not forget to claim back pension relief. This is not automatic and will have to be done via a self-assessment form. Luckily though, you can go back several years, so it's never too late. Anyway, I hope that was useful. Please drop a like on the way out and subscribe for more, and leave any more tips in the comments below, because I'm sure there's going to be loads of stuff that I haven't even mentioned. And until next time, happy investing.